Well, good evening, and welcome to my Your Family Bank webinar. My name is David Babecki. I'm the owner and founder of DB3 Insurance Services. A little bit about myself. For the past 20 years, I've been helping clients with retirement planning, personal life insurance, and business life insurance. But you're not here to hear about that. You're here to hear about learning how to get out of debt in 9 years or less, including your mortgage. So let's get to it. Okay, we're going to use a 7-step presentation. And as we walk through the steps, I'm going to show you some real-life clients, Mark and Joyce. We'll look at their financial picture and see how their impact was for your family bank. So are you sure you're going to have a great retirement, or do you have some doubt? And what if I could show you how to get out of debt in 9 years or less, including your mortgage, without spending any additional money than you're currently spending right now? So let's take a look at the average American household. As you can see with this pie chart, interest and taxes are the two biggest expenditures. Interest includes, of course, interest being paid on debt, not only with your mortgage, but your auto loans, your credit cards, and what have you. Taxes, 40% of that gets paid to taxes. Now that includes more than just your personal income tax. Those would be sales taxes, all sorts of taxes, excise taxes as well. And as you can see, there's 26% left over. So 23% of that goes to lifestyle. Things like buying clothes, going out to eat, vacations, which only leaves 3% for savings with the average American household, which is really not a whole lot. So let's take a look at the Your Family Bank approach. As you can see, interest and taxes are reduced to more manageable levels, whereas savings and lifestyle is increased. So it's pretty positive right there. So let's take a look at the first step, which is knowledge. Knowledge becomes power, but only when you put it to use. What if we could teach you how to reduce the volume of interest you're currently paying to lenders? Get out of debt in approximately 9 years or less. Improve your cash flow. Decrease your taxes, save for college, and retire not only with income, but tax-favored income. So let's take a look at the game of life, which we all play. As you can see, as we start, we accumulate a little bit of credit card debt. From there, we go and perhaps buy a car, so we get an auto loan, go to college, maybe some student loan debt is added. And then perhaps as we move along, we get married and accumulate yet another car, so another car payment. And then we buy our first home, so now we've got a mortgage. After all that, we're ready for a vacation. So we take a vacation, and sometimes we'll go ahead and we'll finance that. Notice the repeat arrow. Many of us go through that over and over again. So let's take a look at the average American household, total assets at age 65. The average American will earn $2 million over their lifetime. Pretty good. But remember that pie chart where only 3% went to savings. So 3% of that $2 million is $60,000. So at age 65, the average American only has $60,000 to fund for retirement. That certainly isn't going to get it done. And it certainly is not the American dream. Step 2, cash flow. Because when you track your money, you control it. So we've got the spending planner, and the spending planner looks for ways to save money and to become more efficient with it. As you can see on the left-hand side of the planner, the category section, basically those are all the things that we deal with on a daily basis. With the planner, we can take a look at what we spent over the past 12 months, and we can average that out as well. Further, we can go ahead and take a look at what we might spend for the next 12 months. We can also break it down into fixed expenses and variable expenses. Fixed expenses, of course, being things like, well, food, mortgages, utilities. Variable expenses, spending. And then finally, we can break it down into what you pay for your expenses and perhaps what your spouse pays. Now, the 80-20 rule is for the plan for the unexpected and the expected. So 20% should go to emergency and emotional. For example, we know that emergencies will pop up. They just happen. And emotional, well, that's just perhaps you're online or you go to the store and you see something you absolutely must have. The 80%, of course, is for long term and everything else. So a bank is a business. So let's take a look at a bank. So let's say you put $10,000 in the bank. And a bank may give you a whopping 1% interest. Actually, that's probably a little high. I think it's more like 0.25% today. If you were to go into that bank the very next day and borrow that $10,000, what do you think your interest rate would be? Well, that depends on your credit score and what the money is going to be used for. One thing we do know is that interest rate is going to be significantly higher than what they're paying you. That's called the spread, and that's how they make money. They also give the dollar 2 chances or 2 jobs to earn. So how would you like to be the bank? Step 3 is debt. To minimize debt is to create additional wealth. So let's take a look at a typical American family of Mark and Joyce. Mark is 37, Joyce is 35. They want to retire at age 65. They make a good living. Between the two of them, they bring in $7,000 per month. And when they retire, they'd like to live on $5,000 per month. They have 3 children, 3, 4, and 8. At present, they have no savings for college. Their main areas of concern are to increase their retirement income down the road, reduce their current debt, get spending under control, have some planning for college expenses, and increase their savings. Let's take a look at their savings and investments first. So they do have an emergency fund of $6,000 to which they contribute $25 per month. For that, they get a whopping 0.25% interest. They also have a 401k, $36,500, to which they contribute $300 per month. That they get a return of around 5% currently. Now let's take a look at their debts. So they have a Visa card at 12% interest. It's a fairly low balance. They do have some medical and dental expense. Their balance there is $2,420, but at least it's 0%. They do have a credit card at 16%, but the balance there is $4,200. And they have furniture expenses. So they've got a balance of $5,988 at 18% interest. They have a car loan with a balance of $13,300 at 8%. And then finally, they've got a mortgage, $153,781 at a 6.5% interest rate. So if we add all that up, they have a total debt load of $180,198 and a total out of monthly pocket expense of $2,177 for their total payments and an average interest rate of 10%. So let's summarize it. Well, they have, as we stated, a total debt load of $180,198. However, we have to compute the interest in there as well. So if we add the interest over the course of their current plan, their total real debt is $380,157, over twice the amount of their actual debt load. So their interest paid is $199,959 if they stay with this schedule for 30 years. So their interest is more than their debt. Let's take a look at their current retirement plan. So currently, as we stated earlier, they've got a current 401k balance of $36,500. To that, they contribute $300 per month, and they get about an annual return of 5%. They're in the 25% tax bracket. So before taxes, at the end of 30 years, before taxes, they should have $408,890. But this is a 401k, and it will be taxed, either in lump sum or as they go, how they pull it out. Since they're in the 25% tax bracket, their after-tax amount is actually $306,668. So that's their actual spendable amount. So let's take a look at what Mark and Joyce were able to accomplish with your family bank. Well, first off, they were free from lenders in 7.8 years as opposed to 30 years. They saved an interest amount of $122,739. They freed up that $21.77 per month that they're currently paying, and they were able to utilize that for saving for retirement. And if they did so in 30 years, they would have over $1 million, $1,004,387. So let's briefly compare the two again. The current plan, after tax, they would have currently $306,668. With your family bank plan, they would have $1,004,387. Now that's a tax-favored retirement. So what is the cost not to do your family bank for Mark and Joyce? Well, as we stated, if they did your family bank, they would have $1,004,387 after 30 years. They would have saved $122,739 in interest. But to be fair, let's subtract out what their current plan would have netted them, which is $306,668. So the cost for Mark and Joyce not to do your family bank is $820,458. That is the benefit that is lost. All right, let's go to step 4, which is taxes, because the less you pay, the more you keep. So let's talk about future tax rates. Do we think tax rates in the future are going to be higher, lower, or stay just about the same? Well, I think most people would agree that taxes are probably going to be higher, especially with all the government debt that's being taken out. So if we think taxes are going to be higher, is postponing them really a good idea? And when should we start tax planning? Well, how about right now? So I have a business proposal for you. You front all the money. You take all the risk. You manage the business on a day-to-day basis. And from 30 years from now, I'll tell you how much you owe me. How does that sound? Would you want to go into business with me? Probably not. This sounds like a horrible business partnership. Yet this is what people do every day when they start a qualified retirement plan with the help of Uncle Sam. So let's take a look at an IRA. Let's take a look at a $5,000 contribution and the 25% tax bracket with 10% growth. So the rule of 72 states that money should double every 7 years with that 10% growth. So if we start with $5,000, in 7 years it'll grow to $10,000. 7 more years that'll grow to $20,000. In 7 more years it'll grow to $40,000. So let's take a look at the tax savings. Well, at $5,000 it would be $1,250. At $10,000 the tax savings would be $2,500. At $20,000 it would be $5,000 of savings. And at $40,000 it would be $10,000 of tax savings. However, let's say we want to pull that money out at the age of 66. Remember, we're in the 25% tax bracket. That tax equals $10,000. So my question is, where's the tax savings? We got a tax break, but we're paying that in taxes. So let's take a closer look again at a different investment. Let's say a $10,000 investment over 28 years at 7% interest in the 25% tax rate. Well, if we paid as we went, the taxable amount, we would have $41,900 in 28 years. If we went with a tax-deferred vehicle like an IRA or a 401k, we would have $49,866 at the end of 28 years. But if we went with a tax-free strategy, we would have $66,488. I know which one I'd like. So step 5 is risk. Don't lose a lifetime of work to risk. So what are your potential risks? Well, how about taxes? I think we agree they're probably going to go up from here. How about the equity markets, the stock market? Very volatile at times. How about inflation, which means the price of things can continue to move up? How about emergencies, those things that we can't really count or plan on, but we know they're going to be there? How about disability, something that we really don't like to think about at all? The same thing with lawsuits and fraud, frankly. Outliving your money is a very real risk for a lot of people. And then, of course, there's death. So step 6 is the big picture. Know where you are going and how to get there. So there are 3 phases of money. There's maximization, making the most out of every dollar. There's accumulation, using every dollar twice, which is what the banks do. And there's distribution, to enjoy a worry-free retirement. Your family bank does all 3. So the big picture plan benefits, what are they? Well, how about arguing less about money? How about finding wasted money with a spending planner? How about improving your cash flow? How about dramatically increasing your savings and getting out of debt faster than you ever thought possible? Learn how to prioritize your accounts as well. And finally, retire with tax-favored income. So the debt summary again for Mark and Joyce. Remember, they had a base amount of $180,198. However, if they keep on their same track as they're currently paying, over 30 years' time, their real debt, including interest, is $380,157. So again, the interest paid, $199,959, more than their basic debt. And it'll take them 30 years to get out of debt. Let's again take a look at what your family bank could accomplish. Well, they'd be free from lenders in 7.8 years. They would have saved $122,739 in interest. They would have freed up $2,177 per month for retirement. And then finally, in 30 years, using that $2,177 for savings, they would have over $1 million as a nest egg for retirement. So now most people see this and immediately make a decision to be like Mark and Joyce. So will that include you? So let's review. Step 1 is knowledge. Step 2 would be improving cash flow. Step 3 is reducing debt. Step 4, reduce taxes. Step 5, minimize the risks. Step 6 is the big picture. And step 7, well, that's your decision, because a goal without a plan is just a wish. So the next steps would be to gather information for your own personalized big picture report. Analyze the data and run reports for your numbers, and then schedule a meeting, because the goal here is to get out of debt. So that's the presentation, and I hope you found value in it. If you'd like to learn more, or if you'd like to know how your family bank concept can help you in your specific situation, simply scan the QR code on the following slide to contact me. Thank you again, and I look forward to helping you get out of debt in approximately 9 years or less.